Volume is seldom discussed in Forex trading, but as any stock trader would tell you, volume can provide valuable insights into the underlying market sentiment. Here I will demonstrate the use of two simple volume filters to improve the reliability of your entry signals.
For exchange-traded assets, volume refers to the number of contracts transacted over that period. It's usually plotted below prices, and gives a good indication of the level of market participation. Volume validates price action. When accompanied with high volume, price moves are more likely to be a true reflection of market sentiment, not a result of random noise. Prices reflect what traders think, while volume reveals the strength of their emotions. In particular, volume can reveal whether trend continuation is likely to occur. For this case, Zoom's rally on high volume was the result of a fundamental impetus driving the move, causing a large number of participants to jump on board. Forex is decentralized, and there is thus no central reporting of trading volumes. But if you look at your MT4 platform, there is a volume indicator available. This is tick volume, which is the number of price changes that occurred over that period. A green bar means tick volume is rising, while a red bar means tick volume is falling. Is tick volume a good substitute for actual trading volume? Prominent authors such as Anna Kohling, who is a strong proponent of volume price analysis, certainly believe so. It makes sense to expect a strong correlation between market activity and price movement. Here we have the January 2021 US non-farm payroll release. Notice the sharp increase in tick volume immediately before and after the release. Each Forex broker will report a slightly different tick volume. Nonetheless, if you use an ECN broker that subscribes directly to the interbank liquidity pool, you should get a quality feed. When making use of volume, I have a couple of recommendations. First, use the average volume over a certain number of periods. There are countless financial transactions occurring around the world. Any single bar will be contaminated with a certain degree of random noise. Using average volume will mitigate the effects of noise and improve your signal reliability. Second, use volume in a relative sense. The volume of any period, when considered in absolute terms, has little value. It should be compared against the market's recent volume history, to get a better estimate of where price is headed. I'll grab a popular Bollinger Band's trend strategy to illustrate the use of tick volume. I will buy when price closes above the 20-period upper Bollinger Band, and sell when price closes below the 20-period lower Bollinger Band. A 100-pip stop loss and trailing stop will be added for trade management. Here's the simple strategy in action, with the trailing stop already locking in a substantial profit. Let's first check out the baseline performance without any volume filters. For backtesting, I'll use the 4-hour Aussie Yen, from 2003 to 2021, using a fixed 0.1 lots per trade. The strategy is profitable in the long term, but there are numerous deep drawdowns. To improve the 38% win rate, let's focus on entry signals that occur on high volume, which increases the probability that the trend will continue. First up is the rising average volume filter, which indicates increasing market participation and a genuine impetus behind the price penetration. Similar to the Bollinger Bands, I'll use a 20-period lookback for the average volume. In this case, a lower band penetration occurred after a brief band squeeze, accompanied by rising volumes. I coded in the rising volume filter as follows. The backtest has improved in every area, especially the maximum drawdown, which fell 28%. The deep U-shaped crater towards the end of the backtest is now gone. Remember I mentioned using volume in a relative sense? Now let's try a high recent volume filter, whereby trades will only be taken if the 20-period average volume exceeds the 100-period average volume. Like the rising volume filter above, this indicates increasing participation in the market. Now let's program it in and backtest. Results are quite similar to those obtained from the rising volume filter. This filter cut off 38% of trades though, while the rising volume filter only cut off 14%. A large sample size improves the reliability of your backtest. When adding filters to your strategy, you need to decide whether the performance improvement justifies the loss of trades. I know what you're thinking. Since both filters improve performance, why not use them together? Here's a comparison of the 4 backtests. With both filters, the win rate has further increased to 42%, boosting both the profit factor and return over maximum drawdown. Now that we have eliminated most of the deep drawdowns from the original strategy, stagnation has dropped from 2200 to 1300 days. That's still a long time, but such statistics are not uncommon if you're trend trading on the higher time frames. So if you're after a simple entry filter that has stood the test of time, do give volume a shot. Look out for high volumes for trend continuation, or low volumes for reversal. For another Bollinger Bands trend following strategy, check out the video at the top. To use them for mean reversion instead, check the video at the bottom.